Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined today by my good friend, colleague, longtime colleague these days now, Bram Gallagher. Bram, welcome back to the show.
Thanks for having me, Jamie. It's always fun.
Yeah. So, Bram, today is our Outlook episode where we're going to talk about our expectations heading into 2026. We're recording now the middle of December, just about to get ready for the holidays and take some time off. So it's a great time to not only opine on where we're going, but maybe a bit of where we've been and how we got there. So I was hoping we could start, and this is now, I think, become an annual tradition of us sort of grading our outlook for 2025 for the year past. And to say it's been an interesting year, I think is an understatement. And we've seen some wild trends. We've seen expectations for inflation sort of reaccelerate with Liberation Day and announced tariffs. We've seen more and more people talking about the K-shaped economy. So where higher income consumers are doing well and lower income consumers are not. We did not see a recession, though we did see government data just stop getting published as the government shut down for a new record length. And then we also saw international travel to the U.S. Sort of pause a bit. We had seen really strong growth. We're essentially back to 2019 levels in terms of international inbound demand. And then we did see a pullback. That was something we actually talked a lot about this time last year on if the increased rhetoric coming from the administration was going to end up impacting travel, and it absolutely did. So, Bram, the goal for me is we're going to talk about some of the predictions we had at the beginning of the year, and then maybe you opine on if you think we got it right or wrong, and if we got it wrong, and sort of what played out instead. So I'm going to start with supply, because supply, interestingly enough, I think it's one of the hardest ones to nail, given that, and we both came from the hotel industry where we had a pipeline report and we could see what hotels were under construction and we could assume those dates are roughly right. Maybe we get a 3-month delay, and we essentially knew what supply growth would be. And now that becomes one of the most difficult variables to forecast. So we had expected supply growth in 2025 to slow, maybe hit a low point at some time in 2025 and then stabilize towards the end of 2025, but not yet really begin to grow in any meaningful way or reaccelerate again. And that supply and demand would roughly be in balance. So given that forecast, what happened?
Well, I think this part of the forecast we definitely scored an A on. We did talk a lot about supply and demand achieving balance. So we saw a dramatic slowdown in supply compared to last year. So about 9.5% in 2024. This year we're looking more at about 4.5%. So as far as listing nights growth. Available listings also, just the individual listing growth, that has certainly slowed for much of the year. We've seen available listing growth under 5%. And at the same time, occupancy has been running sort of neck and neck with 2024 levels as well. So that demand has been keeping up pretty well. Now, not every single month has seen, identical occupancy to the previous year, but in aggregate for the year, we've definitely seen supply and demand growth really draw very, very close to each other. And supply has, I believe, bottomed out in 2025 as predicted.
Yeah. So you jumped a little bit ahead talking about occupancy, but that is my sort of next metric, is talking about what happened overall for occupancy and in many ways demand growth as well. So we had expected around a 5% increase in demand and roughly in line with available supply. But I think importantly, that we thought occupancy was going to tick upward slightly, that we were not going to see another year of declines. We weren't going to see a year of major increases, but it was going to be slightly positive for full year occupancy change. So, and you sort of hinted it just now that, and we did see them roughly in line. So, how would you grade that forecast?
Yeah, I think that was a good forecast. Well, but I would give it an A minus, and here's the reason why. In 2020, I'll tell you, has been a interesting year to forecast. I'm sorry, 2025 has been an interesting year to forecast. Probably the most interesting year that we've had since 2020. So we did expect occupancy to level out, maybe increase a little bit during the year as so sort of supply bottomed out while demand continued growing, and it did in aggregate. But again, the pattern was just a little bit different than what we had anticipated. I was expecting occupancy growth to be a little bit more level during the year, and that's why I said A minus. But what we saw actually is that occupancy was very strong at the beginning of the year. We moved into summer and it started to soften a little bit. In some places, maybe a little bit weaker occupancy than we had in 2024, but other places kind of just coming in right at that same level. So in aggregate, yeah, we're still up a little bit, and I've got some good hopes for the holiday season coming up as well. So December is not yet in the books. I'm thinking that's going to be a good month. So we will be increasing our occupancy just a little bit over 2024, but it was a little bit more imbalanced than I thought.
Yeah. And and I think that plays into some of our grading around ADR growth as well. So we had expected and maybe ADR growth in line with sort of inflation, 2.5 to 3% growth. And that might have been a little aggressive in terms of what we actually saw in terms of ADR growth. So, what happened in terms of pricing in 2025?
Well, we had a lot of stuff go on with the economy that consumers were concerned about, certainly. Now, I will point out too, that the other thing is we've heard a lot of news stories coming out this year. Most of them not, overwhelmingly positive. However, it's been buoying to me to see how resilient the U.S. economy is. We're very, very, very strong coming into this year. We're still going to be in a pretty good place. We've avoided the recession. It may be a little bit early yet, but we might even give Powell the award for the soft landing. Never seen it before in my lifetime. If we pull it off this time, it will be a kind of an economic event. But at the same time, we did see a lot of, I guess, policy changes that were abrupt. And of course, people and consumers, they don't like abrupt changes. It does give them pause for concern. So after that tariff announcement, I guess in April, a lot of expectations were that inflation was going to reaccelerate, and it has. It maintained, it's a little bit higher than we'd like, a little bit hotter than we'd like. So it's maintained some of that heat. Still around. Well, we're not exactly sure because they haven't been doing regular reporting, but between about 2.7 and 3%, I think is the CPI estimate right now, somewhere in that range, which is just, again, a little bit hotter. And interestingly, when we have inflation in the rest of the economy, people do look for places where they can save. And one of those is booking vacation, whether it's downscaling or shortening vacations. It doesn't necessarily mean people are staying home, but it does mean that people are going to be looking for value and rewarding short-term rentals that have that value. And that does translate, I think, into softer ADR growth than we were expecting.
So, and we're sitting here at the end of the year, sort of doing end of the year reviews, and given that sort of prediction outcome, and the fact that sort of nailed supply and demand growth for the year, and that they're roughly in balance full year, and just a little under predicting ADR growth or over predicting ADR growth, I'd give that a solid A for the year in terms of and a year ago sort of nailing what and supply and demand the sort of pretty and big deceleration that sort of played out throughout the year and that we saw across many markets. So good job.
Well, thanks, Jamie. Yeah, I think it was a good year. It was a good year for the short-term rental industry and a good year for our forecast as well.
Yeah, but as we know, predictions are never over. One of the great things about being an economist is you always get to make a new prediction every month, right? So now we sort of talk about the year ahead and expectations for 2026, and we can even opine even further. But in general, I want to start with expectations around the economy, and we'll sort of and have that parlay into expectations around short-term rentals. So Bram, and we're sitting here in December. The Fed's now cut 3 times in a row. We definitely, I think, see some softness in the economy. There's and worry about stagflation and that inflation could and is continuing to reaccelerate while the overall economy is maybe slowing. We're maybe seeing job growth that's and non-existent, though we aren't seeing any major uptick in layoffs. So we've seen unemployment just and tick up slightly over time. Uh, and then we also have a housing market that is pretty solidly still in recession, and we're not seeing any subsequent an uptick in homes being sold, new listings being added, and it does feel like the sort of return of home sales is we might be waiting for a while. Stock market all-time highs, Bitcoin going and pretty seeing some pretty and extreme volatility along with gold. You've got consumer confidence, and according to many surveys, at all-time lows, and consumers not feeling good about the economy. But overall, like GDP, you look at GDP growth and it seems decent. Like, yeah, it's not at the highs it was in terms of growth a year ago or 2 years ago, but it's still holding up relatively well. So, Bram, given all that, and how are you feeling about the economy today? And how are you feeling about the outlook for 2026?
This that a great question because yeah, if you were to just go off the headlines and sort of general sentiment, things are pretty negative. But if you look at the hard numbers, the ones that we do have, things don't look bad. It's very important to keep in mind how strong the economy was going into 2025, how resilient it is. And in my mind, over this last year, it's proved out as well how nimble it is, how it can adapt to these policy changes better than maybe we anticipated. So we look at GDP growth, 2.8% in 2024, very, healthy for a developed economy the size of the US. It's a real nice, healthy growth rate. We're expecting it to be about 1.9% out of Oxford economics this year. So it's smaller, but that 2% sort of, that 2% growth rate right there, that's kind of and that's real growth. That's considered kind of a threshold. Below that is not so good. Above that, everything is gravy. Right at 2% where we're at right now, we're sort of holding steady, and things look to be improving as well. Initially, also, we had a lot of, I think, fear around the tariffs because if you looked at just the general imports that we had and from the countries that we had, and you applied sort of the rough math to get to what the tariffs would be in terms of price effects, they were quite large. But I think we also have seen, I think, a lot of nimbleness in our supply chain, whether that's from the experiences that we had during COVID, whether it's the long period of globalization that we've had and the many decades of logistics that we've had around that. But it looks like we've been able to shrink dependence on imports. That's been a contributor to GDP, certainly this last quarter. We have very few new job openings, but at the same time we've got less people looking for work as well. So it's kind of achieving a balance there. And there's a demographic shift. Of course, we have a lot of baby boomers entering retirement. We know that immigration is down quite a bit, so that is another source of labor that may or that may be facing some headwinds. So while the demand for labor is not, red hot right now, neither is the supply. It's not oversupplied. So that's leading to kind of a pretty well balanced stasis in the labor market, as far as we can see. Inflation too is a little bit different this time around than it was during COVID. So we saw a lot of housing inflation. Whether it's the prices of home or rent inflation. Owner occupied rent was another big source of inflation for a lot of it after those prices went up. And now, right, but since then, we've seen home prices essentially sort of freeze up. They've been locked down. We haven't seen any increases for a while, and in fact, in some places, we're starting to see home prices thaw out a little bit. So that gives me some encouragement, because that's a really important driver of economic growth is the housing market. So to see it starting to thaw out at the same time that we've had some of these international trade difficulties is good. And something that we've been observing is that it certainly has affected travel, the international travel, and that's been diminished. However, whether it's the strength of the euro discouraging people from traveling overseas, or if it's the sort of idea that, well, if people don't want to come to the U.S., they probably don't want the U.S. to come to them either. But whatever the case may be, domestic travel has picked up the slack in a lot of these places where international travel has been diminishing. So all of these really positive signs, I think, for the economy. It's very resilient. We've got some difficulties right now, but it looks like things are starting to improve. Things are starting to normalize. People are navigating their way around the tariffs. They're sort of becoming incorporated as kind of another sort of revenue source for the government. And of course, the Ramsey rule for taxation, right, is you want to tax everything. So perhaps tariffs were a bit low compared to the tax on other sort of domestic services and products.
Okay. So you said a lot there, and I want to try to boil those down into a few numbers.
Apologies, Jamie. I get excited when we start talking about the economy.
No, it's good. So GDP outlook for 2026. Are we positive again, or are we going into recession?
No, we're up back into growth mode. We're going to be lifting up very slightly from about 1.9% to 2.0. And then again in 2027, we'll start to see those fiscal effects from the big budget bill. We also, we're expecting to see employment and real incomes continue to slow. I mean, we've seen some weakness, but they should pick up in 2026. So we're bottoming the growth out in those two as well in 2026. So
We're roughly 4.4% unemployment rate right now. Where do you see that being in 2026?
the top of it doesn't reach 5% in my mind. It
Okay.
stays right below that. So the highest 4.9, 4.8, somewhere along those lines, which again is historically speaking a very healthy unemployment rate. It's higher than some of the records that we saw over the past couple of years, but historically speaking, still pretty consistent with what we might call natural unemployment, and that means there's again balance between the supply of labor and the demand of labor.
All right. So inflation, we've seen it and reaccelerate a bit, and we're maybe what 2.8, 2.9 in terms of year-over-year inflation. Where is that in 2026?
I think it's going to peak out a little bit higher, about 3.5% at the most in 2026, which is a little bit hotter than previous. And that might have a little bit of a negative effect this period, or I'm sorry, this next year on ADR. So our ADR growth is not, it's strengthening next year, but it's not becoming incredibly strong. And one of the reasons is that sort of persistent inflation. But over time, and as people's wages adjust as well, inflation today will add on to prices in ADR tomorrow, because as in real terms, short-term rentals will eventually be able to catch up.
Yeah. So 30-year fixed rate mortgages and running around 6.3% and have been pretty steady in the past 3 months, and even with sort of the Fed cutting rates. So end of 2026, where do you expect mortgage rates to be?
Now, here's one hiccup. I do expect that as time goes on, we're going to see some more affordability in the housing market, but this is primarily going to come from housing prices. I think mortgage rates are probably going to be stuck where they're at, and Oxford Economics agrees with me. So there are concerns about the long run path of inflation that sort of leak into long run interest rates. The Fed cut rates a little early in December, but this probably means one less rate cut in March, say. So they've just essentially taken the same schedule but moved it ahead just about a few weeks. So that's not causing really big shifts in the interest rate. And in fact, the mortgage rates in response to the market really becoming assured that the rates were going to get cut at the December meeting. Mortgage rates went from 6.19 in December 4th. A week later, December 11th, this is the most recent that we have from the Fed, a little bit up, 6.22. So those short run interest rates right now are not really closely coupled with the longer run mortgage rates. So even as the Fed continues to cut those, we're probably going to see mortgage rates stay pretty close to where they are. Maybe getting closer to 6%, but I don't think getting under 6% over the next 2 years. Luckily, of course, housing prices, they haven't changed a whole lot in the last couple of years, and we may see some softening there in the next couple of years. Maybe we already are, in fact.
Yeah, and we've absolutely seen some falling home values in some key sort of short-term rental markets. So, just about every market in Florida seeing some weakness on home values. Markets like Broken Bow seeing an 8% decline, Gatlinburg seeing a 7% decline, Joshua Tree, Austin, Galveston, Orlando all seeing 5 to 6% decline. So definitely some weakness out there this year in terms of home values.
Absolutely. It's great that you bring up the example of, Florida and some of these mountain resorts as well, because that sort of lines up with the survey of expectations we did. I don't know if you want to bring that into the conversation, but it matches pretty well up with our investor survey as far as where people are starting to look, as well as our supply growth forecast as well, where we're expecting to see pretty good increases to supply growth in the resorts, in the resort locations, many of them in Florida.
And that's where I wanted to take it next was on our expectations for supply, and we can sort of relate it to demand too for 2026. So if 2025 was the year where supply growth bottomed, and then sort of, let's say, normalized, and we went and maybe hit a bottom of 2% growth this summer. Now we're seeing more in 3-4% growth. Do you expect us to sit more around that bottom of 2 to 3%, or do we expect it to accelerate or reaccelerate in 2026?
I do think supply is going to reaccelerate in 2026. And I think it's going to accelerate just a tiny bit faster than demand as well. So we did see occupancy go up a bit this year. I'm thinking in 2026 it may go down just a touch. And it's for those reasons. One, we've got these housing prices that have been pretty much level for the last few years. They're starting to decline. Mortgage rates are probably not going to decline a whole lot further, but if you look, just to a couple of years ago, October of 2023, they were around 7.8. So that's considerably lower. It's gone down quite a bit in the last 2 years. So when you put all that together, the investment thesis for short-term rentals looks as positive right now as it has in years since the post-pandemic boom, in fact. That's going to drive up the supply, and particularly in some of these markets where we are starting to see those housing prices thaw out.
So your expectation is to sort of see a direct relationship between those markets that are seeing some of the biggest home value declines and markets where we expect to see supply sort of start to reaccelerate as maybe more investors are able to see positive returns and actually start doing deals in some of these markets again.
Absolutely. And then the only location type where I'm expecting supply to actually slow next year is in the small city rural. It's still going to be the fastest growing location type, but it's slowing from 9.3% this year to about 7.7% in 2026. One of the reasons I believe that small town or small city and rural STR has really exploded over the last few years, becoming the fastest growing supply location type for supply and demand, is the affordability of a lot of the real estate out there. So when prices spiked, they spiked in the cities, they spiked in the suburbs. small city rural, they were a little bit slower to react. So I think a lot of people went there because that was the place where you could afford you could afford to open a short-term rental. So as affordability spreads to other location types, we're going to continue seeing a little bit of a decline in the small city rural as it cools off from those real highs and reacceleration, particularly in the resort locations, but also in suburban locations as well, where I think prices have been they haven't risen as fast as they have some of the urban areas and some of these resort areas as well. Some of the uh, places around mountain lakes and coasts, but are increasingly, I think, attractive for their availability, for the fact that they're convenient to these cities, and also good locations for medium-term rentals, which is a pretty fast-growing segment of the short-term rental space.
No, that all makes sense. Now, uh, on the demand side, and so there's been and so many different and segments that are seeing either growth or declines. Want to get your opinion on a few of them. So starting with and maybe and the group that saw the biggest swing in 2025 that was on inbound international. How do you expect inbound international to the US to respond in 2026? Is it going to be another year of declines, or do we expect the World Cup to sort of turn around the trend?
But here's an X factor because the World Cup is huge international draw. As you said, it has the potential to be the biggest short-term rental event the United States has ever seen. However, there also are some now sort of new policy restrictions about people coming to the US. So those could have some kind of negative sentiment effects on international travel, depending on if they're actually implemented and how they're implemented and people's perceptions around the World Cup there. I'm thinking once we start thinking about it and talking with, the leaders of these cities with all the economic stakeholders that, we're not going to really start demanding 5-year social media histories and that sort of thing from everyone trying to visit the U.S. It's just not tenable. So I think that will probably, as a policy initiative, it will probably fade away. If it doesn't, we could see some issues. But if it does, and we start welcoming folks with open arms to the World Cup and to other sort of international events, I think we could see some thawing of the relationships again because world growth has been impacted as well, and that was a big concern in April. But it hasn't been affected as dramatically as once feared. So that may be the case that Europeans will start looking at their checking accounts and thinking to themselves, these the big bad tariffs, they didn't wipe out our savings like we thought they might have. In addition to that, the euro it has appreciated against the dollar, so the U.S. is a pretty good bargain for European travelers right now, and the World Cup just sweetens the deal that much more.
Yeah, about tariffs wiping out spending. What about lower end travelers, income travelers? So we saw throughout 2025 occupancy deteriorate and most visibly in the and lower tiers, so budget and economy listings. We actually saw on travel and luxury listings hold up and relatively well and continue to stay positive throughout 2025. So, what is your expectation for and the propensity to consume and travel on both either the lower or higher end?
Well, it differs too, depending whether you're talking about hotels versus short-term rentals, also. But yeah, it's this K-shaped economy that we keep hearing of, sort of an upper segment of income or wealth is making up a disproportionate amount of the consumption. So that really does swing things to luxury to some extent. But also that means all the lower income folks are going to be looking for deals. So when we're looking at the hotel data, a lot of the demand growth this year in hotels came from additional promotions and that sort of thing. Something else that we've seen too is that on a per room basis, short-term rentals on average are still a really cheap option, affordable option in many places compared to individual hotel rooms. So I think that gives them a little bit of a little extra angle, I think, It may even be the case that rather than going into lower end individual hotel rooms, you could stay at a mid range or maybe a little bit nicer short term rental and split that bill among many folks. So that may be something that happens. We'll see what happens with equities markets as well. There's been a lot of talk about maybe there's a bubble. So if we see, huge stock price valuations, the wealthy might not feel as wealthy and willing to spend on luxury as they once did. Those are kind of the things I guess we're grappling with.
Okay. And then and maybe we can turn to and what see this and all these sort of changes having in terms of an impact on pricing power. So 2025 and was a year of call it modest ADR growth. If it comes to pass where we see a decline of or a year of slightly declining occupancy levels with supply outpacing demand, and what do you think that impact will mean for pricing power and ability to raise rates in 2026?
Good question as well. Of course, as well as I do, that we've got these two sort of series. There's sort of the repeat rent index as well as ADR. I could talk about them in turn. I think the ADR growth is going to be a little bit stronger next year compared to this year. However, some of that is going to be driven, I think, by the new listings, especially in these resort areas where ADRs are usually pretty high. So if we actually were to take apart the two, ADR versus the repeat rent index, and for listeners who aren't familiar, the repeat rent index takes the mix shift out. It only looks at sort of pre-existing short-term rentals and how they've changed their behavior rather than new listings posting the new ADRs, which may shift the overall average. So repeat rent index, I think, is going to be pretty flat in 2026 because of that, I guess, demand supply imbalance that may happen. But it won't be negative. We're not going to be decreasing prices. It's more like if you're in the market, you're kind of holding steady to this 2025 prices, which definitely increased from 2024. But as we're seeing sort of a little bit of weakness in the labor market and in real incomes, we're probably going to want to hold those steady. And that's a pretty usual strategy. Meanwhile, those new additions coming in are going to be priced a little bit higher than the market. So ADR will rise. By 2027, some of that imbalance, I think, will have gone away. We're still going to see ADRs increasing higher than repeat rent index, but we will see the repeat rent index then start to see some real increases around 1.5% to 2%, and then ADRs a bit more than that, maybe up to a half to a whole percentage point higher than the RRI gain. So we're going to be a little bit on the demand is slowing a little bit in response to some of these economic conditions, but it should pick up again in 2026. So that will bottom out in 2026. Supply is already sort of on the mend. And in 2027, they're both going to find each other again. And we'll resume with, I think, good pricing power moving forward from there.
Okay, Bram. And this has been a ton of fun for me to sort of hear your thoughts on the economy. I'll summarize in that it's going to be probably a good, not great year. Occupancies relatively stable, supply reaccelerating, maybe reaccelerating before we get the sort of reacceleration in demand, causing some slight occupancy declines in 2026, but coming back in line for 2027. World Cup is definitely gonna or should be a major driver of inbound demand to the U.S., but there's still going to be some concern on the lower end, and with tariffs still causing higher inflation and eating into the sort of incomes of lower income travelers. But ultimately, we're going to maybe muddle through in 2026 and then look for growth again in 2027. How are you feeling about that summary?
That sounds like a good summary. And the other thing I would point out is that we saw lots of supply growth right after the pandemic. We saw lots of people trying short-term rentals for the first time. And I think it may look a little bit different this time. We're going to see supply growth reaccelerate, but I think it's going to be, it's going to lean a little bit more on people that have either experience in this field or are really serious about getting into hospitality and really serious about making it work and putting in a lot of work into their short-term rental to make it as good as possible. So that may surprise us on the upside a little bit because we might see really good operational performance as well. Because this one isn't as sort of widely, I guess, we've definitely seen improvement in investment conditions, but we're not seeing sort of sensationalist news articles like we did back in 2021 and 22.
All right. So what's the wild card next year? And I hear about AI and a potential bubble. I hear about the stock market and a potential bubble, and maybe the two of those are very correlated. And there's and always the opportunity that and something happens in the housing market that we aren't expecting. There's potentially or will be a new Fed chair in May with Jerome Powell's sort of term ending, and the chance that the and White House is maybe enacting more direct control over what the Fed is doing. Like, is there something out there that either is a major worry to you on what could happen to the economy in 2026, or are there also maybe some upside risks? And I guess what I'm asking is sort of the tail risks of like what's out there that could lead to a significantly worse or a significantly better outlook for 2026.
Policy, I think, is the biggest wild card that we've got for either way, right? So we've got an administration that's already proven that it likes to work on the I guess the tech model of moving fast, maybe breaking things, figuring out what worked and what didn't, after the fact. So you never know exactly what kind of policy could come down the pike. On the other hand, we've been doing really well considering that we've had a lot of large sort of far-reaching policies that have been enacted, and we do have, I think, some big potential for gains with the fiscal benefits that we're actually going to start seeing. We might start seeing a big shift in consumer confidence, right? As once again, people are starting to consider the tariffs not as big of a threat as maybe they once were. We might also start seeing some of those, tariff rates be negotiated as well. We know that President Trump also likes to make deals. Many times we can change sort of these terms as we go along. So there's definitely upside risk as well. So we might be, freeing up trade a little bit faster, or maybe stimulating domestic industries directly. We've heard some talk about that. Equities. I wish I could predict the price of equities, Jamie. I wouldn't probably be working for AirDNA if I could, but there that is always a risk. On the other hand, you've got a lot of I think you've got a lot of buzz going into AI and tech, but I think there's been a lot of progress in other industries as well in the U.S. That maybe not that haven't gotten the capital or the attention. So even if those stocks may be a little overvalued, that's maybe some of the rest of the stock market is a bit undervalued. So we might not. So we might see those sort of offset each other in some way. So I'm not extremely worried about the equity situation. Moreover, if we were to lose a lot of the gains that we've seen in the last few years, Americans' wealth positions are still in really, really good shape. Even without the enormous run up in prices of homes that we saw during the pandemic, even without the gigantic gains that the AI has made in the stock market, people's wealth positions are still in pretty good shape. Their balance sheets in good shape as well. The amount that the Americans hold compared to their incomes is pretty good. And so I think we can see definite surprises to the upside.
Yeah, no, I agree. Something we didn't even talk about was the impact of the big beautiful bill from 2025, and I hear and definitely some upside, and we talked about it, and after it was enacted, and yes, deficit spending, but in a way that and with the sort of deferred withholdings from no tax on tips or overtime, that I think a lot of people could be seeing significantly bigger tax returns in 2026 as they file in the first quarter and are getting those checks. which perfect time of the year to book your next vacation if you get
I was going to say, timing couldn't be better.
You get your tax return in March and then book your summer travel. So I'm hoping for some big benefits there. And we also return to 100% depreciation for short-term rentals, where that could be another sort of tailwind on supply growth as well.
Yeah. So again, I think the savvy investor is really going to have a good time in 2026. Exploring those tax incentives is part of that.
Awesome. So Bram, had a ton of fun. Thank you so much for opining on the outlook for 2026. For those of you that have made it this far, the link to the full report that we put out will be in the show notes. And we appreciate everyone listening in and wish everyone the best in 2026.